the end, so just give me a shout. Thanks very much. Title of the paper is Productivity in Ireland's Domestically Owned Economy. This is an update. Sorry here. In 2024, my colleague Chris Smart and myself, we published a paper, Productivity in Ireland's Domestically Owned Economy, a comparative survey, whereby we were able to isolate productivity in the domestic market sectors and compare them with other what are called small advanced open economies in Europe to try to identify where we are strong in productivity, what sectors were strong, and what sectors were weak. This presentation updates that comparison to 21 to 23. Now we use Eurostat's globalization and business statistics. We use national accounts and GDP price indices to measure what can be called business productivity. Some call it labor productivity, but a better phrase would be for business productivity, which is based on hours per worked. The comparator countries that we're using are those used by the Economic and Evaluation Service that the Irish government, by the Irish government: Austria, Belgium, Denmark, Finland, Ireland, Luxembourg, Netherlands, Norway, and Sweden. All averages that you'll see coming up are weighted. And it's an average of the 3 years in order to reduce the impact of lumpy data or missing years. Now, it has to be stated, I'm sure not to people here, but it will have to be stated because it needs to be stated in the public debate. Productivity equals turnover minus non-labor costs. Neither labor or capital composition forms part of the basic business or labor productivity measurement. In other words, wages and profits. They are not included in the inputs. So we measure, this is what happens is when you subtract non-labor inputs from turnover, what do you get? Value added, that famous phrase. And what we do, quite simply, is say how much value added do workers across the different sectors, across the different countries, how much they generate per hour in both nominal and in real terms using the GDP deflator. One big difference between what Chris and I were doing last time and this time, Eurostat has added health, education, and arts and entertainment into what they call the market economy, which seems a bit bizarre. But previously, they only measured the market economy without those sectors, revenue sectors. Now, what they measure in health and education are only market operators operating in an open market. I think that definition is contestable, but we're not going to do it here. So at the national level, at an overall economy level, we have to take that into account. So what have we got? In the average of between 2021 and 2023, we see in nominal terms that Ireland is at the bottom of the table. It is 20% below the weighted average of other small open economies. Leaving aside Luxembourg is always kind of a special case, we can see that Denmark tops the league at a nominal level, with Belgium and Sweden also operating above the small open economy average. As I said, we are at the bottom. When you put it into real terms, same story. We're about 19% below the average. Belgium kind of slides past Denmark, Denmark being a lot of inflation in Denmark, very high cost economy. But nonetheless, the same three above the average: Belgium, Denmark, Sweden, and Ireland at the bottom. There are just, actually, this is just a repeat of what I just said there, going over the chart. But nonetheless, these are significant differences. To give you an idea, in 2023, if we increased our productivity to our peer level group, this would raise value added by approximately 25 billion euros. 25 billion in 1 year coming from the domestic sector. And that, in a very crude terms, that would be divided between wages and profits, depending on bargaining power and whatever the sector might be. That is a significant boost. Or looked at another way, that's a significant reduction of what we would have if we were at the average. So we'll get into the sectoral comparisons, as was prior to COVID in the years 2017 to 2019. The professional and scientific, we really do well. We're at the top of the league in professional and scientific, nearly 30% above the average. Now, the main driver in that is management consultancy. So I leave you to ponder kind of what that means about Irish domestic enterprise and its interface with global capital. But actually, it's management consultancy that's actually even double the productivity levels of our peer group. And adjusted administrative services, this excludes rental and leasing. We do that to exclude the aviation sector, just as G&I Star excludes that sector. That and hospitality are below average, but not that significant. But then we get to the rest of the sectors: health, information and communication, financial services, and especially construction and transport and storage. Construction is particularly notable because we're constantly talking about how we have to increase our output. It might start by actually using the same amount of inputs and just increasing the efficiency of our outputs, because we are 30% below the small open economy average. Now, we don't have figures for education. That's why it's not there. Data, and we don't have data for arts and entertainment. I would suspect that if you did have them, it still wouldn't change the overall dynamic. They're not that large sectors. There, I've just, that's exactly what I just said there, describing the graph. Also, just to note, unfortunately, there's insufficient data to measure Irish domestic manufacturing. It only reports 1 out of 3 years. Chris and I established a method whereby we would average 2 out of 3 years, but 1 was just a little bit too risky. Though there is some data coming from the CSO's own measurement that suggests our domestic manufacturing sector has improved. Whether that's a compositional effect or whether there's just been an improvement of productivity, we don't know, because we can't break down the subsectors. We're using the CSO's data. But there are 2 sectors that we can look at, subsectors. Kind of hard to do it because, again, Eurostat, when they redid their database, they grouped together, unfortunately, they grouped together subsectors in a way that makes comparison difficult. But we can do food and drink. And as you can see, food and drink is extremely important in our domestic manufacturing base. It makes up 1/3 of all domestic manufacturing employment. In our peer group, it's less than 20%. So it shows that we rely quite a bit on food and drink. And while we are not the lowest in productivity, Finland and Sweden are lower, the Irish food and drink sector is 16% below the small open economy average. So in an area which should be a strength for us, we're weak. And I suspect, given just reading kind of patchy data going back over the years, that the drinks part of the food and drink sector holds up, but the food part doesn't. That certainly was the case between 2017 and 2019. And given that road hauliers have got a lot of publicity, blockading refinery, blockading motorways, and all sorts of things like that, thought it might be useful to look at the road haulage sector. If the Irish domestic sector is at the bottom of the table, which it is, the road haulage sector creates a new bottom. In fact, it is so far at the bottom, we can't even see it anymore. You can see that it's 42% behind the small open economies average. That is actually consistent with 2017 to 2019 output as well. It is a low value, low investment, and low wage sector. Now, obviously, Ireland's island status doesn't work to our advantage, but you know, because we can't build economies of scale in a way that road haulage firms can do so on the continent. But there are some problems. There's low level investments, but especially in electric vehicles. We're only putting in 1/8 the amount of investment in electric vehicles as sectors and other economies are doing to kind of help decarbonize the sector. And there is a high level of own account enterprises, self-employed. It's a very small, fragmented sector with nearly 50% being self-employed compared to other countries where self-employment makes up about 10 or 15%. They're usually dominated by companies. So this is an extremely inefficient sector, and the government's only response to the crisis was to give them more money, more subsidy. Again, I don't want to make any kind of political judgment on that. I'll let you do that. Just looking quickly through some sectors, and then we're going to wrap up. Just looking at business investment. Again, this is a headline figure. This doesn't go into sectoral data, though we could. Obviously, business investment is indispensable to increasing productivity and competitiveness. But as you can see, the headline rate shows Ireland again at the bottom of the table. Not surprising, you will find that low productivity and low investment go hand in hand. Now, chicken and egg, do you need to increase your productivity so that you can have enough capital compensation out of which you can pay your investment? Or do you need to raise your investment to actually produce that high productivity? I suspect it's two sides of the same coin. But again, we would have to more than double our rate of business investment in the domestic sector to reach self-employed average. Another problem is not only do we have a low investment sector, it goes into what might be called the wrong sectors. Irish capital is heavily directed, investment is heavily directed towards the low value added and low wage sectors of hospitality and distribution being wholesale retail. 20% of total business investment goes to these two sectors compared to 10% among our peer group in Europe. So it's little investment. There is it's going in not into high value added high wage sectors. Then we can look at enterprise research and development expenditure. Now, unfortunately, this is our in-house R&D activities. Eurostat only measures industry and construction. But again, we find that Irish levels of R&D expenditure in the domestic sector are, again, extremely low. We'd have to increase that expenditure by 5-fold to reach our peer group average. This is not to say just because you spend a lot of money on R&D, you're going to, get a better result or a better output. But if you don't spend much on R&D, you're not going to get any output or any result. So that's the key thing to measure it. And finally, just in terms of comparisons, goods exports, again, okay, we're not at the bottom. Luxembourg is. One shouldn't be too surprised that Luxembourg wouldn't have a high level of goods exports. I don't think they have much of a manufacturing sector or whatever. Mostly concentrated in financial and professional and scientific. But, they're at the bottom, but we're just barely above the bottom in terms of how much we export in goods from the domestic sector. And we, as you can see, we compare poorly to our peer group. We would have to probably double our goods exports in order, something like 12 billion euros increase, double it to reach that peer group average. Now, what are the reasons for productivity output? We didn't go into the explanations why. Not going to now. I'm not going to read all these things out. Mentioned them some before. Obviously, peripherality is a problem. Fragmentation, lack of scale, managerial deficits, because some authors have suggested that the multinationals grab up all the good managers and all the good talent, leaving the domestic sector with no skills and no talent. Take that argument so far, you know, it's debatable to what that is. Entry barriers, reduced market competition, low expenditure on education, training, and R&D, and critically, low level of employee voice, collective bargaining, employee participation. But as we've seen, the summary is quite clear. If anything, it's getting worse. We found that prior to COVID, we were 15% below the average. Now we're 19%, bearing in mind that we're not quite measuring like with like, but the productivity gap seems to be worsening, and seems to be worsening in key NACE sectors. We have low levels of investment. We have low levels of expenditure on R&D, and the value of goods exports, again, is extremely low. The challenge in the first instance is to define our deficits, then investigate their causes, and then begin developing strategies with the full and equal participation of all the main stakeholders. And I would suggest that we do that as a matter of urgency. Thank you.